Okay, so if you're like me, in any investment you do, you're always looking and asking what can go wrong in this deal, right? So the investment returns can be projected that you're going to make awesome returns, going to be consistent cash flow, but that doesn't always happen the way that you'd expect. Or if you talk to people that have been doing this for more than a few years, it doesn't always go as expected. And so right now, we're also seeing it with rising interest rates. We're seeing just more risks than we did a year or 2 years ago. And so my friend Mauricio Rauld is here today. He's actually an SEC attorney that works with syndicators like myself and other fund managers to help try to do things from a compliant level, as well as just trying to manage risk for investors. So I think it's really important for passive investors to have kind of a behind the curtain look of just what are some of the risks that we consider when we look at deals from a legal standpoint, or both even as a passive investor, what are the things you should be concerned about? Because Warren Buffett has this quote. He says, rule number one of investing is don't lose money. And rule number two is don't forget about rule number one. So Mauricio, how you doing today, man? Good to see you.
I'm doing great, man. Rule number 3 is listen to Warren Buffett.
Exactly. Or Mauricio Rauld and stay out of jail. That's right.
That's right. Yeah.
So, Mauricio, awesome. Good to have you, man. I know we've been friends for a few years and just you've been in a lot of similar circles, have a lot of respect for you. And we were joking before that your approach, you're conservative, which is good. And, as a syndicator, you have to find someone that you connect with. And I love what you share with our group, but give people a little bit of background about yourself and kind of what you do and how it relates to investing.
Yeah. So thanks, Bronson. Really appreciate you having me on. I'm a syndication attorney. So my job is to make sure that those that are raising capital stay out of jail. That's essentially my short.
That's a good thing. That's a good thing.
Yeah. We just make sure that they do it in full compliance with federal and state securities laws. Really what we do. Are they going to go to jail? I mean, Bernie Madoff went to jail, but typically if you're non-compliant, there are some consequences. But yeah, my job is to make sure, look, anytime somebody's out there raising money and taking money from passive investors, my job is not only to protect the sponsor, to be honest with you, but really the law requires me to make disclosures to the passive investors so that when they make that investment, they're making the investment with their eyes wide open, that they know exactly what's going on. They have all the material facts, and then they can make an intelligent decision whether it's a good investment for them or not. And that's what we do. We make sure that not only does the sponsor do everything in compliance, follow the rules, follow the regulations, follow the laws, but also provide the necessary and legal disclosures to the passive investors so they can make proper investments.
Right. So I want to talk about that for a minute, because I know as a passive investor, I passively invest in deals as well. And sometimes I'll get documents that are, 90 to 200 pages and, everything's disclosed in there, but it's going to take me like a week to read the whole thing. Right?
Yeah, for sure.
A little bit of lawyer speak. I know there's a lot of, once you understand the format, there's some kind of rubber stamp stuff that goes in there or kind of boilerplate language. But, how, I guess, I've had some investors ask me, why can't this thing just be like 3 pages or something? But there's so much that goes into these things, and it's, if the operator gets struck by lightning, or if, your cat dies, or, whatever happens, all these different contingencies.
Yeah.
But can you give kind of, is it just simply to avoid lawsuits and have more disclosures, or what are the reasons these documents are so big?
Yeah, you can blame Congress for that. So, it's just the laws, right? So not always, right? So I want to be clear. So, in some circumstances, for example, if all of the investors happen to be accredited investors, for example, the level of disclosures from a legal standpoint can be a little bit less. Some people call it like a light disclosure. But the minute you have non-accredited investors in a deal, right? People who have less than generally $1 million or less in net worth, or a couple $100,000 a year, then the law requires the sponsor. It's not optional. It's not, maybe sometimes requires them to give them a full set of disclosure documents that are the same level of disclosures as when you actually are a public company. Like when you're actually, so it's not anybody's fault. I think at this point, passive investors just need to understand that that's what they're going to find. And to be honest, they sound like a lot of documents, but one of those documents is the operating agreement, for example, or the LP agreement. And that generally is 40 or 50 pages just in and of itself. And then by the time you add a questionnaire and a subscription agreement, you're already there probably at around 90 pages. And so then it becomes the other document, the PPM, the private placement memorandum, which is really the disclosure document. How comprehensive does that have to be? And the answer to that is simply, do they have non-accredited investors as potential investors? And then, what exemption will also dictate, what they have to disclose. But it's a legal thing.
Yeah, absolutely. And I know disclosures are, it's important. It's important people know, ways they could lose money, and all the different things have to be disclosed. You mentioned this before, for those that aren't familiar with, most investors are, but some are not, the idea of an accredited investor, some history here. And it only, in the past, it only was like 3% of the population was considered accredited based on having a certain income or a certain net worth. And, but now, it's something like 20%, or it's a much higher amount. And the SEC has talked about, I've heard you actually mention this from the stage at a couple events, that they're going to change it to have some sort of certification or take a test type of thing, or there's some other ways. Can you talk a little bit about some of the changes that are happening and what that will do for maybe people that are not accredited? I get some people that are like, hey, I'm not accredited, but I want to get in these deals, and there's really no path for me to do it, right?
Yeah, I'm glad I had the statistics here somewhere, but I'm glad you brought them out. But yeah, so the $1 million, for example, the threshold that they currently use, which is $1 million in net worth, excluding primary residence, right? So you can't count your house, because otherwise everybody here in California would probably be accredited after
Right,
that huge. But that law of the $1 million passed in 1982. Which is now what, 40 some odd years ago. And so back then, as you mentioned, $1 million was a lot of money. Only 3% of the population, had that, or the equivalent of their income. And so over the years, that number has been technically inflated down, where $1 million just isn't. I mean, I know people kind of joke about it. It really isn't what it used to be 40 years ago. And so there's a lot of discussion now from the SEC, and they've kind of dropped hints, and it's on their regulatory agenda to discuss, but they want to update the definition. There's rumors flying around on what that's going to look like. But, my position has been, look, if you just go back and adjust the $1 million just for CPI, I wouldn't even say inflation. I don't want to get you in all hot and bothered, but like the official CPI number over the last 40 years, you're at about a $2.9 million number. So if they're going to increase that number, which I think they are, I've heard as much as 10. But if they are, it makes sense to me that they would go somewhere around, at least start at that $3 million range. And then what happens is people get comments, and they ask information for the public. So that number may get negotiated down, or lobbyists may get involved. But I think they're going to start at 3, maybe the end somewhere between 2 and 3. And it actually makes sense, because what's already on the books, Bronze, which I know is that there's a path right now to become an accredited investor, even though you don't have the net worth or accreditation. So if you're out there listening and you're a passive investor, or you'd like to be a passive investor, but you're not accredited, and you're like, hey, all these great deals are out there and I'm not eligible for because I'm not accredited yet, and I'll get there eventually, but not there now. There is a path. So the SEC a couple of years ago now passed, they just recognized, like we all do, that net worth and income doesn't necessarily mean that you're smart, sophisticated, know what you're doing. All of us know, really wealthy individuals who are the dumbest people in the room. And we all know really, people of modest means who are really smart. So that's not a good test. And so they passed a rule actually a couple of years ago now, where the SEC was going to start allowing a certification program where you would go through and take a class, a seminar, a self-course, whatever that looks like, and actually get certified and become an accredited investor. Very similar of now, when you get an investment advisory license or whatever. Unfortunately, when that law passed, the only path at that moment was people who had investment advisory licenses. So right now, even though you're not accredited, if you have a Series 7 or a Series 82 or even a Series 65 securities license, you are going to be considered accredited automatically. And the idea was that the SEC was going to roll out other certification mechanisms for you to go get it, like I said, a test and get it certified. That hasn't happened yet. And if you read not to get too geeky on this, but if you read the legislative history and everything, you can see that people that even though it passed, they weren't thrilled about that path without increasing the number, right? And so this actually makes a ton of sense to me. So I think what's going to end up happening is that you're going to have two options. You're either going to automatically qualify because you make $3 million, or you have a $3 million in net worth or higher, or whatever the number is. But if you're not, that doesn't mean you can't get there. That just means you're going to have to take the route of going to get a certification program, which I think once that other law passes, they're going to start rolling out more and more of these certification programs, because obviously these companies have to be licensed to give the accreditation. And then we'll actually know what that's going to look like. Because right now we have no clue whether this is a self-taught course, if it's a semester class, like what does it look like?
Yeah, and that's interesting. I did a video about this a little while ago. And I got a lot of comments about it because people were really interested. How can I become accredited without being accredited? And what I left out of the video, and I think I learned this from you as well, it's not just taking the test and passing, which I used to be an investment advisor, but you actually have to be at that point carried with some sort of investment advisory firm, or be a broker dealer or something, which I don't know how difficult that is. I mean, I suppose you could say I have some assets. I got friends and family. It's more work, and a lot of people wouldn't necessarily do it, but it is also a path currently available. So, but it's not really a good idea if you're ever thinking about becoming a syndicator, because I was actually on the side of my medical device sales I did for years. I did investment advising, and I actually had to leave the investment advisory stuff to become a syndicator because they just didn't want to deal with the compliance. So it's interesting how like there's all these things 100%. Out there. So have you heard any, like, I know we've been talking about this for like a year, any updates on this, or just kind of whenever it happens? And
I literally go on the SEC website. They have a press release section, and I go there at least once or twice a week because it's just any minute now. It just depends on when they're going to have that. And what's going to happen, just so you know, what's going to happen is they're going to come out with a proposed rule, and it's just going to happen one day. One day you're going to wake up and it's going to be like, and I'll be all over. Right? We'll be on. We can get together and we can talk about it again when that happens. And so there's a proposed rule, and what happens is they give everybody, like you and me and whoever is interested, there's a comment period. So you've got like 60 days to say this is a good idea, this is a bad idea, 3 million is too much, it should be 10, no, that's too much, it should, whatever. And so then they take that into consideration. Then usually 2 or 3 quarters after that, they'll come out with a final rule that they take into that account. And so we're far away from a final rule, but the next time it's, like I said, it's on their spring, even though technically we're in the, I guess, winter, but for it's their spring regulatory agenda. It's on there to discuss. Yeah,
absolutely. Let's shift gears for a minute here. So let's say as a passive investor, I'm looking at deals, I'm reading, the nice lengthy paperwork that you and your team or someone else has put together. Probably, let's say not your team, but someone else. What are some things that, like if you're a passive, do you passively invest in deals?
I do.
So what are like the 2 or 3 areas that you go to, like, okay, I just really want to make sure in these certain areas, I understand how this is structured?
Yep. So the first thing I do is actually, obviously, I'm reviewing it to make sure that it matches whatever my understanding of the deal is, right? So I've had conversations with the sponsor, or I've looked at the deck or whatever. So that's number one. The other thing I look at is to make sure that the PPM, the disclosure document, matches the operating agreement, because oftentimes that doesn't happen. And if there's a disparity between those 2 documents, the operating agreement is gonna win. So if you think you're getting a 7% preferred and that's in the PPM, but the operating agreement doesn't say a preferred return, then there's no preferred return unless you amend the operating agreement. So that's another thing I look at. What I really look at is obviously, cash calls is another thing I want to look at that provision. Am I going to be required to provide additional capital if the deal goes south? And if I don't, what are the ramifications of that? Am I going to get diluted? Are they going to go get a loan somewhere? Like, what does that look like? So I always pay attention to that provision. Obviously, I want to know who's really managing the deal, because a lot of times there's 4, 5, 6, and sometimes way too many 10 or 12 sponsors on the team, and you may have a relationship with one of them, but is that really the person who at the end of the day is making those day-to-day decisions? So I like to look at that provision. But one that I really want to hone in on, because this is something really important, is pay attention to the distribution section. How are the distributions categorized? Because that's going to have a huge impact on not only your tax bill, but also on the back end when they sell the asset, what the waterfall is going to look like. Because generally speaking, you want to find out, when I'm getting my cash flow, let's just say, I invest $100,000 and somebody gives me $10,000 in year 1. So I'm thinking, great, I got a 10% cash on cash return. Are they counting that as just returning $10,000 of my principal? So that $100,000 that I gave them now goes down to 90. And then if they give me another 10 grand the following year, it goes down to 80. Is that how they're calculating it? Or are they just giving me the $10,000 and they still owe me 100,000? Because what they owe me is going to determine what the payout's going to look at on the back end. So that's something I very look. And obviously the tax ramifications of that too. Is it a return of my principal, return of capital, or is it a return on principal? And that goes the same with the refinances. When projects get refinanced, how is that treated? Those are usually returns of capital, and they lower what we call a unrecovered capital account, is what we kind of keep track of, which is separate from accounting and all that stuff. It's just how much money did you put in, and then how much of that money have we given back to you? That number will definitely go back on a refinance, but a lot of times it'll also go down on your quarterly distributions as well.
Right. Thanks for sharing. That's really helpful to go over. And if go back and listen to that, if you heard that and you're like, wait, what did he say? Go back and take some notes on that. It was really good. So what would you say right now? Obviously things are changing. Interest rates are rising or have been rising for a while. We're seeing some deals. You're hearing kind of rumors of distress in certain, especially multifamily or other sorts of real estate deals. What are some things that you're seeing now kind of in relation to that on the legal side, or at least on the deal side, that maybe some clients, obviously nothing specific, but just you're seeing people are trying to do to try to really make sure that maybe they're running short of cash, or it's a development deal or something? What kind of things are you seeing? Are you seeing a lot of rumblings of this?
Yeah, we're having a lot of discussions with some clients about that cash call provision in the operating agreement, how that works and that procedure is. Because yes, we're getting to a point where some, not our clients as well, but certainly in the industry, people are starting to get a little tight, especially if they've purchased something in the last, 2 or 3 years. It's not so much the purchase price. I mean, as you know, multifamily, which is what we mostly do. I mean, that's arguably down 10, 15, 20%, depending on the area where you're at. It's not so much the price, because who cares about the price if you keep going, but it's the interest rate lock. Those loans that a lot of these folks have gotten over the last 3 years have been these bridge loans. And so they're coming to an end of those 3 years, and they basically have to re-up that interest rate, that interest, and they're getting the loan, but the banks are starting to require additional capital to be escrowed because they want to lock in that interest rate. And so the bank may become and say, okay, great, I'll extend your note for another year, but you need to put $500,000. You need to put $1 million into escrow so I know it's there. And there is no $1 million, to be had. And so then you've got to go to the investors or figure out, how am I going to get this $1 million? So that's becoming an issue as well. And then, we saw this during COVID a little bit, but when their NOI starts to go down a little bit, especially if they got that variable rate, then that debt service coverage ratio that the banks want to have of usually about 1.25, that starts to dip below that number. And so the banks, same thing, they say, hey, it's almost like a margin account, and you're a little bit low on the margin. So, hey, you got to deposit a little bit more money because we need to get that coverage ratio is a little too low, and we don't want to come in to take over the properties, which is something I have heard, by the way, Bronson, is like through my clients, I'm understanding that a lot of lenders at this point anyway don't want to be taking back the properties, right? So they're working with the lender, with the property owners. They're trying to do everything possible so they don't have to take it back, but they are requiring sometimes cash. And so now operators have to go back to their investors and say, hey, we need another $500,000. So everybody kick in $2 or $3 grand or 10 grand or 15, whatever the number is. And a lot of times investors either don't have the money or feel like they don't want to throw more good money after bad, right?
Yeah, that's interesting. I think it's something you don't realize, I think, when you go into this business, just how much power lenders have. I mean, it's crazy. We're hearing there was a deal we did recently where, they have all these provisions in there and all these things they can do or whatever, and lenders can, not allow you to make distributions to investors.
Right.
And a lot of times that provision is in there, but they, lenders don't enforce. They don't really care once you close on the deal, whatever. We had one that's like, no, like you're not meeting this really strict thing in this area. And they wouldn't allow us to make a distribution. But it's interesting how that happens. And then, like you talked about, when it comes to the DSCR, a lot of these deals, and that's where like that value add component, I think, is just so critical. Like, was the value really added over the first 2 years, or did people just sit on their hands? Right. And Ken McElroy talks about 2023 being the year of operations, right? That this is the year that you either operate it and you get it done, or you maybe you don't hold on to the property, because if you can't get in there and see that value add and see the value go up and get to those ratios, you're going to be in trouble.
One of the issues that has come up that I've noticed, actually, some of my clients, Kenny's obviously one of them, but some other clients have also made this point where over the year, especially the first-time syndicators or sort of the more greener syndicators, they've been hitting their ROI numbers and returning what they've been promised, but that's all been due to that rate cap that's been compressing. And so if you actually look under the hood, and even though you got your return and they hit the numbers and all that stuff, if you look under, you realize that it wasn't because they increased NOI or occupancy or hit those metrics. It actually was just because, hey, the property went up, way more than we thought. And I don't say we got bailed out, but that's really why we hit it. So now that you're not getting that, right now, the cap rates are actually, they're actually, going up and your prices are going down a little bit, then, like, to your point, now you really got to operate this thing right. You've got to get that NOI up. If it's a value add, you better be getting those increased rents. You better be getting those increased occupants, because if you're not going to be, you're not going to be adding value. And with the cap rate going up, and I forget, Kenny does a great job of saying for every cap rate point, when it goes up, this is how much NOI, he's got some formula he knows. But the reality is your NOI may not be keeping up with that debt coverage ratio the bank wants. So that's why banks are starting to make some phone calls and putting you into this sort of special category. Another client calls it this black box or whatever, which puts you in a special category over here.
Yeah, it is. It's interesting. So what would you say, I mean, right now, are you seeing many, like as far as volume, are you seeing many multifamily deals, kind of new deals getting done, or are you just seeing kind of pretty much a standstill when it comes to?
I wouldn't call it a standstill. I mean, we had a huge dip from, let's call it, late halfway of last year. So let's talk May, June, July. That's kind of where we peaked from the volume that we were seeing. And I've been talking to a lot of brokers as well, and that's where their volume peaked. Then it kind of bottomed down towards the end of the year. I mean, we saw from peak to valley from, let's say, June to, October, November. It was a pretty steep drop for our business and also for a lot of brokers. Now it's kind of stabilized. I stabilized to starting to creep up again. So our volume is starting to kind of go back in the right direction. But certainly the amount of volume has has decreased. I think it's stabilized is the way I would say right now.
Yeah. Okay. Yeah, that's interesting. Yeah, it's just there's things are changing really fast. Are you seeing other deals pop up around the real estate space? Like we've shifted a little bit to do more ATM stuff. We're doing car washes. We got an oil and gas kind of speculative deal going. Are you seeing a lot more of that stuff picking up?
Yeah, I mean, we're doing probably the same, very similar to the oil and gas deals. We got a client and a lot of clients in this carbon capture space, and
Right.
so that's becoming a popular as more and more people find out about it. It's got a lot of interesting. I actually did one of my podcasts a couple of weeks ago was with my CPA, and we kind of talked about, is this even a better tax benefit than real estate? Because in some aspect it is. And people are just baffled when they hear some of because everybody's into real estate. They're not into oil and gas. They think it's, oh, that's drillers and this all those kind of complicated stuff over here. But it's got some interesting tax plays. So that's been happening a lot. And I think people still are doing a lot more self-storage. I see a lot more self-storage deals lately. And obviously in a recessionary environment, a lot of people are downgrading or downsizing their houses or moving. And so that tends to be a pretty decent business thing as well. But and then mobile home parks is also with the affordability issue as well. I would say mobile home parks are also ticking up. But the majority of our deals, I don't want to mislead anyone. I mean, probably 60 to 70% of our deals are multifamily deals, and that's sort of our bread and butter.
Yeah, it's interesting that there are things out there that offer, more tax benefits, even against ordinary income. And I'm not a tax person,
Yeah.
and you're not either, but it is kind of amazing.
Yeah.
Wanted to ask you as well, a couple more questions, but just about when you're vetting a deal, part of that is the documents, part of it's the paperwork and the, whatever. But when it comes to like an operator, what are some things you look for when it comes to the team, the track record, all that stuff?
That's the number one thing, right? I mean, I've written articles on this where, yes, you're a passive investor, but the only thing you should be doing, and there's a bunch of questions I recommend people ask, but the number one thing is what is the experience of the operator? You got to do your due diligence of the operator. Anybody can put together a pretty business plan and pretty pictures and all that stuff, but at the end of the day, can they execute? And do they have expertise in this particular? I mean, you were talking about some other asset classes, like if you've been a mobile home park guy for the last 20 years, and this deal happens to be multifamily. Well, I mean, they've got a track record, but is it really? It's not about asset class, or maybe they're crushing the Texas market, and now this one happens to be in Idaho, or do they have a team? All that kind of stuff. So, due diligence is by far, and for me, it's always been relationships. So I don't invest with anyone unless I've established a really, really solid relationship. I've gotten to know them at a personal level. I've been down to their offices. I know their operations pretty well. I know their team. I've talked to other. It's easier for me because I know all the investors who have invested. Right. That's probably one of the biggest challenges if you're a passive investor. But I would say do your best. Either on social media or at these conferences that you're going to, try and find somebody who's invested in those deals before and get some real-time feedback. What was the communication like? Did they deliver on what they promised? Those are probably, again, I recognize I'm in a little bit of a unique situation because I do have literally, I pretty, any sponsor, I could probably just send out a little tweet and be like, hey, who's invested with this operator? And I'd probably get, a bunch of people doing that. But that's I cannot overstate how important, as vetting the sponsor, because that's all you do. Once you sign the documents that we prepare,
you're done.
You've got very little to no input at all. And you want it that way, by the way, for the limited liability part. You don't want to be, exposed to make, if something goes wrong. But you got to put all that energy on that front end due diligence with the sponsor. Way more important than the actual deal or the market. The sponsor comes number one. Do they have the track record, the team, the experience to pull it off? And what's their communication track record? Do they communicate? I always like to talk to people about, hey, what happens if things go wrong? But to be honest, it's been a while since we've had some turbulent times, although now it's coming back. So hopefully Ken McElroy always likes to say communication builds trust. And, when things don't go well, they should be doubling down and tripling down on the communication, not sticking their head in the sand. And so you want to know what type of operator are they. Do they stick their head in the sand when things aren't going well, or do they start doing daily calls with you to let you know exactly what's going on up to the second?
Yeah, no, you're absolutely right. I mean, the operator is so important. And it's interesting, I look at you're an insider. Obviously, you've got access to all this, all these operators or deals or track record, all this stuff, and you're seeing it at a very detailed level, which is very unique. But I mean, even, I go to a lot of conferences and it's just amazing, somebody asked me about an operator, like I usually know them or know someone that's part of their team. And once in a while, like I'll get, like I had an investor who's a sophisticated investor, part of one of my deals. And she said, hey, I'm thinking about investing with this guy. And she sent me this thing. And it was like some Facebook ad clickbait kind of thing. And I was like, I don't know who this guy is. I've never heard of this guy. And like, I would just beware because I don't know anybody that knows this guy, right? So then those are the kind of people. So that's just, but getting to conferences and live events for passive investors is really, really valuable. Mauricio, we have just a couple more minutes. I wanted to ask you as an investor. I mean, it's interesting. You both look at the legal side, you're an investor, and you talk numbers. So I'm sure there was a lot of background that went into that. But what would you say? You mentioned a couple of advices, getting to conferences and getting to know folks. Do you have any other tips for passive investors that are getting started and things they should do to at least be aware of as they kind of get going in real estate or other investing?
I mean, I would definitely do that. I mean, meetups is another one, or Zoom calls, or just the community as a whole. But I'm big into reading, so I think books are just a great way to educate. If you're looking for education piece, I would start with books and podcasts and all that stuff. And then once you've got that down, I would start out there. And there's literally a meetup every night somewhere regarding real estate, and somebody's teaching it. But again, it's less about the teaching's important, but it's really about the community and the relationships that you're going to establish, the people you're going to meet, whoever's putting down the meetup together. Just go meet those people. That's my best recommendation. And to your point, not to your point, but what you've been doing, which is so amazing, don't limit yourself to real estate. Learn about macroeconomics. Listen to Bronson's, all those episodes with George Gavin and Brian London and Russell Gray that talk macro. That's so important. And so expand your knowledge, man. I listen to those guys religiously because it is all tied together. How the economy is going, or what the interest rate looks like, or what the Fed's doing. It all comes into play, even if you're a passive real estate investor. So listen to all that stuff.
Yeah, absolutely. No, that's great. It's great advice, man. I think, you just add so much to the community, both as an operator. I've gotten a lot from just your information you put out there. You're putting out a ton of content. I know the last year you put out a lot more, which is awesome. So I just really appreciate all the value you bring to so many folks and the ways you're connected in our industry. But Mauricio, what's a good way for people to connect with you in other ways and what you're doing?
Yeah, I especially if if you're looking for passive investment, just check out the YouTube channel. You can it's under my name. I'm not that hard to find, or you can just go to mauriciorauld.com and then /YouTube. Putting, as you mentioned, a ton of content, not only for syndicators, but also for passive, anything that's got to do with real estate. I'm over there. And if you want to get a hold of me, you can always just go to askmauricio.com, and that'll get you to our contact page, and you can shoot me an email or something.
Awesome, man. Well, I appreciate you. I look forward to seeing you at an upcoming event. Probably have you in Belize as well. So we'll grab a cocktail there.
Yeah, for sure.
Summit, which will be fun. But appreciate you coming in today.
No, thanks for having me, man. Really appreciate it.
Always amazing me talking to Mauricio, just how much he knows about a lot of things. He's talking numbers, he's talking vetting teams, vetting sponsors, and he is a passive investor. So, it's amazing. One of the challenges I found before, I was what I call an insider, right? I'm more of a real estate insider, going to a lot of events. I'm a part of a lot of deals. There's a lot of, I have some experience now, so I've learned, who's who and who's doing what. But as a passive investor, you do not have that. And the best way to get that is to go to events. We do an event in Southern California called PB Pasadena, which stands for For Investors by Investors. So we're not pitching anything there, but it's the type of meetup that you should attend wherever you live, or if you want to come check it out. We do it the first Wednesday of the month. And we're having about 75 or 100 people there, which has been awesome. But what happens is you get in the room with other passive investors, other operators, other syndicators. You can also do this for national conferences. It seems like Texas is kind of the golden place to do conferences. But it's really exciting. So really, when you focus on your own education, your financial education is really what gives you the foundation to make a lot of money. It's not just, hey, I invested and I had this tip and I did whatever. It's that you actually understand what deals are great deals, where risk lies, and you can speak finance. So if that's something you're learning, then just continue on that path. I want to encourage you by listening to this channel. There's other channels that do it, other podcasts and shows and books, and Mauricio mentioned books. So definitely check those out. But thanks for taking the time to educate yourself. Look forward to seeing you on the next episode of the Mailbox Money Show.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.